We got a problem here because the US government is struggling to find enough people to borrow money from. So what are they doing? They're increasing their rescue operations intervention. And this is bad for the US government, and this is bad for you and me. So let me explain. Okay, so why does the government need to borrow money? And the answer is actually very straightforward. It's because the US government has an overspending problem. They spend more money than they make. So this year, the US government's going to spend about $7 trillion. And they're going to make in tax revenue, tax collections, about $5 trillion. Okay, so how does that happen? How does that work? How do you spend $7 trillion when you only make $5 trillion? The answer is very straightforward. They borrow the difference. They borrow money from individuals, from private institutions, from other countries, etc. All right. Then that leads us to this very good question. Why doesn't the US government just print the money instead of borrowing money? And the answer is very simple. It's because you have to remember that the US government does not have a money printer. That's the Federal Reserve. And the Federal Reserve is not a part of the US government. Therefore, the US government, to fund their overspending problem, they have to borrow the money. Now, let's answer this question. How does the US government borrow money? Like, how does it actually work? So, the US government issues IUS that investors can buy. They're called Treasury securities. And honestly, you probably have some of these in your retirement accounts. If you allocated any of your retirement money to a bond fund, to a target date fund, a balance fund, a fixed income fund, etc. So maybe you remember, some of those words, like the title of the funds when you were allocating your money. I'm sure you didn't read the fine prints, but Treasury bills are IUS that come due, they mature in 1 year or less. Treasury notes, or IUS, that come due in 2 to 10 years. And you have Treasury bonds that are IUS that come due in 20 to 30 years. Anyways, what's going on here is very simple. The US government needs money. An investor, which can be institutions, other countries, they buy a Treasury security, which again is like an IOU, and the US government pays you interest for lending them money. So basically, anybody that holds a Treasury security, the US government is paying them interest. Now, I just want to say that it's very important that you understand that the bond price and the interest rates have an inverse relationship. So I'm going to explain this in a way that everybody understands. So okay, here's the high-level overview of it. If the bond price falls, then the interest rate goes up. If the bond price increases, then the interest rate goes down. Again, don't worry, I'm going to explain it very thoroughly. And I'm going to do so with an example, a very simple one. So let's just say that you need money right now. And let's just say that Brian, I'm an investor willing to lend you money. And I want you to tell me which scenario is going to be better for you and which one's going to be better for me. So let's take a look at scenario A. In this scenario, I'm going to give you $97 right now, and you're going to pay me back $100 in 1 year. Okay? So that's the first scenario. And then the next scenario is that I'll give you $94 right now, and you pay me back $100 in 1 year. So you being the person that needs money, which is a better scenario for you? Now, obviously, scenario A is going to be it's going to be much better for you. Okay? Well, why is that? It's because in scenario A, you're getting charged an interest rate of 3% a year. And in scenario B, you're getting charged an interest rate of 6% a year. So, it's as simple as that. As the price goes down, the interest rate goes up. If the price goes up, the interest rate goes down. It's an inverse relationship between the two. And you know what? This is going to make it even easier for you to understand. So we have two scenarios, A and B. And in scenario A, you pay $97 for this Treasury IOU right now, and then the government's going to pay you back $100 in 1 year. And then you have scenario B, where you pay $94 for the Treasury IOU right now, and the government's going to pay you back $100 in 1 year. Now, I just want to ask you, which scenario do you think that the government prefers? And of course, the government prefers scenario A because the interest rate that they're going to get charged is lower. Okay, now why would the price of the Treasury IOU fall from $97 to $94? Like, who determines that? And the answer is that the market does. The bond markets, just like the stock markets, there's a bond market. Bonds go up and down in value, which changes the yield or changes the interest rate. Okay, now that you know that, why would the price of a Treasury bond go down in value? It's because there's not enough buyers. It's simply supply and demand. So I want you to think about it like the stock market. So let's just say there's a stock out there, you're looking at it, and nobody wants to buy it. So if nobody wants to buy that stock, do you think the price of the stock's going to go shooting higher? Like, of course not, because there's no buyers, there's no buying pressure because nobody wants it. Okay, so that was an extreme example. I'm not saying that there's no willing buyers for U.S. government debts. I'm just saying, why are there not enough buyers? And let's answer that. Okay, you want to know why? It's because the U.S. government has a severe overspending problem. This is the national debts over the past 60 years. I mean, as you can see, it's really been piling up in the 21st century. After the financial crisis of 2008, the government spent money like crazy to stimulate the economy, to prevent an economic depression. And that required a lot of borrowed money. And then after the pandemic, we took it to the next level, as you can clearly see. And I just want to say, look, Obama overspends more than Bush. Trump overspends more than Obama. Biden overspends more than Trump. And Trump is overspending more than Biden. Like, it doesn't matter what political party the president is, the government's going to overspend and they're going to keep on adding to this debt. Anyways, this is why there's not enough buyers, because the market is being flooded with U.S. treasuries. And why is that the case? It's because the government needs to borrow more and more money. Now they're in debts of $40 trillion. And I just want you to think about that. You need to find a lot of people willing to lend you money. If you're asking people to lend you $40 trillion, because you have to remember that the government has not been paying down their debt balance. They just keep on refinancing it. And then they're going to need what? Another $2 trillion on top of that each year, because the government is overspending by about $2 trillion each year. All right, so let's go back to this example, this scenario where we have scenario A and scenario B. So let's just say that I do lend you money. I give you $97 right now, and you're going to pay me back $100 in 1 year. Great, right? Everybody's happy. But then let's just say that you need more money, and you come back to me, and you ask me, and you say, hey, Brian, can you lend me some more money? And then I say, no, like, I don't want to. Like, I'm good. Sorry. And then you're like, oh, crap, like, I need that money. And then you say to me, okay, Brian, how about you just give me $96 right now, and then I'll give you $100 in 1 year. And then I'm going to respond with like, no, I'm good. Like, I don't have any more money to lend you. Like, I don't want to lend you any more money. So you're like, oh man, like, okay, I got to ask my friend Jose for money now because Brian's not going to lend me money at that rate. And then you're like, Jose, can you give me $97 right now, and I'll give you $100 in a year? And then Jose tells you that, like, no, I don't want to do that. And then you say, okay, how about $96? Give me $96 right now. I'll give you $100 in a year. And then Jose just shakes his head and he's like, no, he doesn't want to do it. He doesn't want to go along with it. And then you're like, okay, just give me 95 right now and I'll give you 100 in a year. And Jose still doesn't want to do it. And you're like, okay, give me 94 and I'll give you $100 in a year. And then Jose's like, okay, fine. I'll give you $94 right now and you give me $100 in a year. So do you see what happened? You sweetened the deal by giving Jose a better interest rate. Okay. Why? Because you couldn't find enough people to lend you money at that lower interest rate. That's why. And the thing is, that you went straight to Jose because you know that your cousin's not going to lend you any money. And you know that your little brother's not going to lend you any money. And some of you are thinking that I don't even have a little brother. But that's exactly my point. There's not enough people willing to lend you money at your desired rates. So the offer needs to be sweetened at your expense. And that is exactly the problem that the U.S. government is seeing right now. They're issuing trillions of dollars of these IUs, Treasury securities, each year. And now they're having trouble finding buyers. So that's why the interest rate on Treasury bonds have been climbing higher. So what you're looking at is a 5-year chart. So the government was able to get people to lend money to them at a 1.7% interest rate about 5 years ago. Now it's above 5%. And I want you to think about that. The government needed $1.8 trillion last year. They're going to need $2 trillion this year. Next year, another 2. It's probably going to be more than $2 trillion next year. So where are they going to find all these people to lend them money? There's not going to be enough lenders at a 2% interest rate or at 3% or 4% or even 5%. And if the interest rate goes to 6%, then the government's fiscal budget is going to be screwed. And I just want you to look at this nonsense. This is how much the government has been paying in interest on their debts each year. In 2020, the interest expense for the government was at $345 billion, and it's been going higher and higher each and every year. And then 2025 was $970 billion in interest expense. That's way more than we spend on the military. This year, in 2026, it's going to be about $1.1 trillion of interest expense. That is nuts. So you see, that's the problem. $1.1 trillion in interest expense. And I just want you to know, that's just the interest. That's not paying down the debt. And that's a lot of money when the government's total revenue is going to be about $5 trillion. That's like if your household makes $100,000 a year and the interest payments on your credit card is $20,000 a year. And that's just for the interest, not even paying down the balance. Like, this is a bad situation. So a very good question is, where are the buyers of the Treasury securities? Essentially, the people willing to lend money to the U.S. governments. So let's take a look at foreign lenders. And here are the largest foreign holders of U.S. Treasury. IUS. Japan holds $1.1 trillion in U.S. Treasuries. In other words, we owe Japan $1.1 trillion, or at least the federal government does. Okay, so will Japan be buying more of our U.S. Treasuries? In other words, will they be lending more money to the U.S. governments? And my expectation is no way. No way. Because if you didn't know, Japan is going through their currency crisis right now. And they've actually been selling U.S. Treasuries, which is not doing any favors for the U.S. government. The U.S. government needs buyers of their treasuries, not sellers. You know, they're selling. That's the opposite. That hurts the U.S. government and raises interest rates. And Japan has threatened us to sell a ton of their treasuries, which is why the U.S. government and the Federal Reserve, they had to intervene, the yen crisis intervention, to prevent Japan from selling their treasuries. Because if they did that, they dumped their treasuries, the bond prices would fall, and the interest rates the U.S. would go up, okay? And then we have the United Kingdom, okay? Like, come on, like, give me a break. The UK is struggling. You think they have money, like a significant amount, or something that's going to make a difference, like that quantity of money to lend to the U.S. government. No, they don't. And China, they're not going to help us. They're not lending us money. China has been selling their Treasury IUS. They've been buying physical gold. They got better things to do with their money. So they're not going to lend money to the U.S. government. No way. Like, do you think our allies in the Middle East are going to lend us money? Like, do you think they're in the mood? I don't think so. Okay. So what happens when there's not enough people willing to lend the U.S. government money? then the interest rate is going to go up, and the U.S. government cannot financially afford that. So, what's the game plan? Like, what do we do? Where do we go from here? So the game plan is like, this is what's happening. The Federal Reserve is using their money printer. They're okay. So for this year, 2026, they're going to print about, like they're already in the process of it, they're going to print about $200 billion, and they're going to use that money to buy Treasury IUs. So that, okay, why are they going to do that? So that the price of Treasuries will go up and the interest rates will come down, so that the government doesn't have to pay a higher interest rate. And of course, that begs the question, is that inflationary when the Federal Reserve is going to print a bunch of money out of thin air like that? And the answer is yes, but we have bigger fires to put out. Like, that's the mentality of the U.S. government and the Federal Reserve. So that's the Federal Reserve. But that is not enough. There still aren't enough buyers of treasuries at the government's desired interest rates. Therefore, the U.S. Treasury had to step in. So now the Federal Reserve and the Treasury are tag teaming this problem. In July of 2024, the Treasury started buying $8 billion of treasuries each quarter. So every 3 months, or at a rate of $32 billion a year. And that wasn't enough. Then in 2025, the Treasury started buying $16 billion of treasuries each quarter. So essentially doubling the pace. And that's $64 billion a year. Okay. And now, as of August 19th, 2026, the Treasury is increasing it to $32 billion a quarter. So that's a run rate of about $128 billion a year. Okay, so you have the Federal Reserve. They're going to spend about $200 billion this year buying up U.S. Treasuries to artificially increase the price of U.S. Treasuries so that interest rates either, they get capped, that they don't keep shooting up, or hopefully that they come down a little bit. And then you have the Treasury. They're going to spend about $128 billion buying up U.S. Treasuries, again, to artificially increase the price. But you know what? Okay, let's just call it about $300 billion, right, of intervention money, rescue operations. But it's still not going to work. The reason why I'm saying that is because, well, each year, the deficit, like this year, is going to be about $2 trillion. There's $2 trillion of additional borrowing, or $2 trillion more, Treasury securities flooding the markets, and you're talking about $300 billion of intervention money. Okay, so what's going to happen? What's my prediction? Okay, this is the way I see it. The Treasury is intervening like they're doing the rescue operation for a run rate of $128 billion a year, right? But they can always increase that, rescue effort. They can go from $128 billion a year to, let's just say, this is just an example, let's just say $200 billion a year, right? But the thing is that is a lot of money, $200 billion for the U.S. governments. And you have to remember that the U.S. government does not have a money printer. So, of course, what the U.S. government's going to do is they're going to try to do some financial engineering, try to swap out some of the long-term debt for short-term debt, like refinance it like that. But that's not solving the problem. So the way I see it, this is not going to solve the problem either. But the Federal Reserve is going to be the last option, the people with the money printers. And when they print money, they're going to print a lot because they're going to have to print enough to make a difference. And that's going to, of course, spike inflation. And this is why it's bad for you and me. Like, wonderful, right? And you know what? I'm just going to speak to you sincerely, just straight from the hearts. I am not going to let these people screw me over, because why should I? Like, I know what they're doing. I know what they're up to. They're going to try to inflate the debt away, but it's not going to work. It's like these people have never picked up a history book in their life. And I just want to say, I am like basically giving out lifeboats in my financial community. And you could join for free if you want. We're increasing the amount of free data and info that we're giving to our free members. So I'm just saying that the government's playbook is very straightforward. They're very easy to read, and it's just obvious what they're trying to do and where this is headed. And I just want to share with everyone that I beat the S&P 500 by sixfold in 2025. And right now I am doubling the performance of the S&P 500 in 2026. And a fun fact that I want to share with you is that there is a very high probability that 2027 is going to be a spectacular year for the markets, because the third year in a presidential cycle is historically the strongest year by a wide margin. Anyways, come join us. The link is down below. Thank you so much and wish you an excellent day. Take care.